Hi everybody. Well, democracy in the UK may have gone down the tube, but the silver lining is we won't have a week ahead with the words Brexit deadline in the title for a while. Anyway, coming up this week, there is a lot of UK, Chinese and inflation data out. Pinterest has its IPO on the New York Stock Exchange, and it's the first full thrust week of US corporate earnings, including Q1 results from Netflix. Now, as always, we start with the economic calendar. So UK unemployment data, the first one to watch on Tuesday, where the unemployment rate is expected to fall slightly, but the more important element is the wage growth. China GDP is a big one because of the global growth concerns, pretty much centered on China itself. And then we have a slew of inflation data, as mentioned previously, but I'm going to discuss those a little more in just a moment. And then the major corporate earnings to watch this week are as follows. Okay, I can't help it. One thing that is interesting about the Brexit extension until October is how long can the Bank of England sit on the fence? Well, you might argue, and I in fact am arguing, that because the deadline is in the region of 6 months, it's too long. So basically, if Theresa May had got her way and the extension had been a shorter one, then the Bank of England could reasonably say, well, we'll wait and see how Brexit turns out. They can't really do that if we're waiting until the end of October. If there are genuine pressures in the economy that justify higher interest rates, they can't delay. So the point being, I would say the Bank of England now is more likely to raise rates in the short term, at least once, in order to mitigate the inflation pressures. And that's why the wage data, as well as inflation data from the UK, are important, because that's a measure of how quickly the Bank of England are going to have to move on this. China GDP, another big one, as I mentioned, because of the global growth concerns, specifically about the slowdown in China. Now, as a reminder, the government is targeting GDP in the range of 6.0 to 6.5%. So generally speaking, if this data comes in worse than expected, then obviously you would expect a bit of a sell-off in Chinese assets, perhaps a bit of a sell-off more globally in equities. But I think maybe the data comes in softer than the 6.4% previously, but if it holds above 6.0, then we're probably okay. Below 6, which would be a bit of a surprise, and then we could see a fairly steep sell-off in equities, which are looking pretty overbought at the moment. So it's one to watch. The other point for this week is inflation. We have it from the UK, the Eurozone and Japan. So that pretty much covers all the major currencies outside of the dollar if we're talking FX markets. Collectively, they can give us some ideas about whether central banks, the other central banks other than the Fed, should be more dovish than the Fed, which is being very dovish itself, that we know from the minutes last week. So it's a battle for dovishness at the moment. Obviously, if this inflation data from other global central banks comes in on the softer side, then they perhaps are going to have to hold off on following suit on the Fed in tightening policy. And so argument there is that actually, should all this inflation data come in soft from other parts of the world, that would be good for the US dollar. So then as far as corporate earnings, we've got the rest of the US banks, but the one that catches my eye is Netflix. So the shares are up a tasty 35% this year. So congrats to anyone who dived in after that December drop. They are now consolidating between $350 to $380. My guess is that these earnings caused the breakout of that trading range. Obviously, the question is which way. As I see it, there are the earnings themselves and the expectations for the earnings. The consensus forecast is for a drop of 11%, and that follows a 27% drop in Q4 earnings per share. So given that the 3-year average is 140%, a drop of 27% last quarter and an expected drop of 11% this quarter, that's a pretty huge slowdown. So that's probably why shares dropped off quite dramatically last year, and other big US tech shares did as well. Now the expectations are much lower. So thus the earnings which have been beaten down, the earnings expectation rather, are easier to beat. Why could they beat? Well, one thing to remember is that Netflix did hike its prices in Q1, and in January they forecast 8.9 million new users. So that's a 6% increase in monthly users of Netflix, all paying higher prices. And then just quickly, I wanted to mention Pinterest. We'll cover the Pinterest IPO a bit more this week. I have to admit I'm not a big user. My wife loves it though. One point I'd like to make quickly here is the fact that the ride-hailing app Lyft's recent IPO was such a botch, so much so that they're now threatening to sue Morgan Stanley. That would probably mean that Pinterest won't want a repeat performance and are probably going to be a little bit more conservative on their pricing of the IPO, which means that there's a better chance of going up post-IPO than if they were more aggressive on the pricing. Thank you very much for watching. Good luck trading this week. And if you want to see these videos as soon as they're released, please follow myself and LCG on YouTube and social media.